your roadmap to the latest in auto. Welcome to Highway Herald. In this episode, we delve into the perplexing world of the EV market. Growth has stalled, and the middle class remains hesitant about new technology. Governments are scaling back electrification plans. Intriguingly, both established and startup EV makers are struggling to turn a profit, leading to significant losses. The market is sounding the alarm, and we're here to discuss 7 clear indicators of this crisis. Indicator number 7. The debate over Elon Musk's pay package and its impact on Tesla shareholders. Proxy advisory firm Glass Lewis has urged Tesla shareholders to reject CEO Elon Musk's $56 billion pay package, citing its excessive size and potential harm to smaller shareholders. This comes as Tesla seeks a revote on Musk's 2018 pay package, previously nullified by a Delaware judge. Tesla shareholders are due to vote on June 13th. Proxy advisory firms warn that Tesla shareholders risk stock dilution if Musk receives the massive stock grant. Glass Lewis also highlighted that Musk, who doesn't draw a salary from Tesla, is already well compensated through his 12.9% ownership of Tesla, valued at about $74 billion. This stake challenges the very basis that the 2018 grant, as structured and sized, was even necessary, according to Glass Lewis. The 2018 pay deal for Musk would issue about 304 million new shares, creating a dilution effect of about 9%. This concern is amplified by Musk's concentrated ownership, which would increase to 22.4% if the 2018 pay package were approved next month. Indicator number 6. The grim future of startups. The EV sector is currently in a financial tailspin. Legacy car makers, buoyed by strong sales of gas-only and hybrid vehicles, are weathering the storm. But startups, who bet big on electrification, are now feeling the pinch. EV startups, like their established counterparts, have failed to crack the EV economy. They're hemorrhaging money on every car they manufacture due to supply chain issues, high raw material prices, and production inefficiencies. Rivian, despite strong backing from Amazon, is a prime example. It's spending far more on production than it should, with insider reports suggesting an average cost of $200,000 per EV. Some startups are still securing new investors, but others, like Canoo, are showing signs of pessimism. Last September, Canoo had just $6.8 million in cash and equivalents, a stark contrast to the $415 million it had in 2022. In general, almost all EV startups, including Tesla, are struggling. Reports of massive revenue declines, rallied shares, and layoffs are common, with Tesla recently cutting 10% of its global workforce. Indicator number 5. Fisker's uncertain road ahead. Fisker faced a tumultuous year, marked by significant losses and dwindling investor confidence. The company's financial struggles were evident when its stock price plummeted from 75 to just 40 cents per share within a week in March. Fisker's woes were compounded by low sales numbers, with only half of the 10,000 electric SUVs produced last year reaching customers. The company's unusual business model, which outsources most of its production, has proven to be a liability in today's cost-saving environment. For instance, its Ocean SUV is manufactured in Austria by Magna. Fisker reported a loss of $463.6 million in the final quarter of last year, despite generating $200 million in revenue. With these figures in mind, the company resorted to desperate measures, including laying off 15% of its workforce. While these decisions may prolong its survival, Fisker's future remains uncertain. This wouldn't be the first time Fisker has teetered on the brink of bankruptcy. Before we delve deeper, we'd appreciate it if you could subscribe to Highway Herald. Your support fuels our passion to create more content like this. Now let's explore indicator number 4, GM's U-turn towards hybrids. GM, one of the first traditional automakers to announce a shift to all-electric production, is now facing a bumpy road. Despite investing billions in new technologies, including the problematic Ultium platform, GM's ambitious plans to sell 400,000 EVs annually by 2026 seem increasingly unrealistic, given the current market slowdown. GM's best effort so far has been just over 100,000 units, largely due to the now discontinued Chevy Bolt. With billions invested and production numbers falling short of profitability, GM is being forced to postpone most of its EV projects to conserve capital. Recent revisions in EPA's electrification plans have led GM to put its most important EV projects, including the all-electric Chevy Silverado and GMC Sierra, on hold. The production of the new drive unit has also been delayed. Meanwhile, GM dealers, unhappy with the company's insistence on selling electric vehicles, are advocating for a return to hybrids. Recognizing the current trend towards gas-electric vehicles, GM has announced plans to introduce a few hybrid models in the near future. Indicator number 3, Ford's close call with rapid electrification. Like GM, Ford misjudged the American buyer's readiness for EV technology and is now counting the cost. In the last year alone, Ford lost over $5 billion on EVs, leading to a halt in its $12 billion investments. For every F-150 Lightning sold last year, it lost at least $36,000. The all-electric pickup truck sales have dwindled, prompting Ford to have production and curb losses. The Mustang Mach-E, once a hot commodity, is now gathering dust on dealer lots. This slowdown, coupled with recent government revisions to electrification plans, has brought some relief. The F-150 Lightning has underperformed, shifting Ford's focus to its hybrid version. Amidst major reliability issues and safety concerns, Ford is now concentrating on hybrid technology and banking on its ICE F-Series for profits. Ford dealers are stepping back from ambitious electrification programs, and the company is following suit, recognizing the need to pause electrification efforts and recover from substantial losses. Indicator number 2, market slowdown. Many EV manufacturers are on the brink of bankruptcy due to inaccurate sales growth projections. Profitability in the EV sector hinges on achieving a certain sales volume, a target that seems increasingly elusive as growth has significantly slowed down. EV makers, buoyed by early adopters, had optimistic business plans a few years ago. In the first quarter of 2022, the year-over-year growth was an impressive 81%, with sales 20% higher than the previous quarter. By the same quarter in 2023, the year-over-year growth had dropped to 46%. Fast forward to today, and the landscape is drastically different. The first quarter of this year ended with a meager 2.6% year-over-year growth, with quarter-over-quarter changes actually in the negative, as sales dropped 15% compared to the last quarter of 2023. With a stabilized supply chain and record-high production, there's a significant imbalance between demand and supply. EVs are harder to sell than ever, forcing manufacturers to offer substantial discounts, leading to increased losses and raising questions about the sustainability of the market. Indicator number 1, new regulations. The financial struggles of EV makers, both legacy and startups, are evident. However, the recent EPA proposal may be the most significant indicator. The EPA has revised its previous proposal, now aiming for just 1/3 of new cars to be all-electric by 2032. This change, coupled with lowered fleet emissions requirements, allows legacy car makers to continue selling gas-powered vehicles, especially pickup trucks, without any powertrain modifications. This shift is largely a response to the market slowdown, but it's also a lifeline for desperate car makers. Significant losses, labor issues, and general instability have prompted the government to ease off on EVs, offering respite to industry giants like Ford and GM. With this new plan, these companies can continue to reap substantial profits from their ICE pickup trucks, while full electrification takes a back seat, awaiting more favorable conditions. That concludes today's episode. Don't forget to subscribe to Highway Herald to stay in the loop with future updates and videos. See you next time.